day, nice doji day, right? And again, probably potentially a third very strong selling day. So 3 times the market has tried to get up there and it's formed this resistance zone. Okay, so this would be deemed resistance or overhead resistance. We then have our next structure. Right? We've got a double bottom on the monthly. In other words, we've got a very, very nice double bottom that's forming on the monthly charts. Okay, there's our first and there's our second. And this is effectively our price discovery low and high. Okay, in other words, the market hasn't taken out a double bottom on the monthlies. It hasn't consolidated or closed below it. And we're obviously getting a third addition to that. Okay, so we have June, we have September, we have October. So over a period of 3-4 months, the market's been incapable of closing below this. Once we break out below that, we go into price discovery mode. Okay. Notice again, another overhead positioning, doji day. Okay, a second selling day. And a third nice rejection day. So we now have overhead resistance. And again, gets confirmed with a nice false breakout. Okay, so remember what we said. Yes, we deem things support and resistance when there's 3 or more, when we have, enough rejection within a specific zone. But the ultimate, confirmation is when the market gets beyond that point, as we can see at 42, 46, the market brings in that potential break, but fails and gets rejected. Okay, so that tells us that yes, this was a significant area and we were right in calling this a resistance or overhead resistance. Okay, we now have a first example of a ledge. Now what we can see here, notice a ledge being different to resistance. Resistance is over a longer period of time. A ledge is a 1, is a 2, is a 3. Okay, 3 times the market is forming this ledge at this lower price called 39.79. In other words, it gets down there, it looks like it's going to continue, and the market just suddenly turns around. Okay, so that's the difference between a ledge and support and resistance. So support and resistance is a little bit longer time frame, whereas a ledge is within a shorter space of time where it just cannot get beyond a certain price point. Now remember, with all these structures, ultimately, you must be looking at the breakout. In other words, what happens once we take out this trend channel? And that's that day over there. What happens once we take out this monthly double bottom, which is this day here? Okay. What happens once we take out this overhead resistance, which is this day here, and then ultimately this day here? Okay, so that's the purpose, is that we first identify these structures, we put the lines on our chart, but then we prepare ourselves for the day that that structure resolves itself. And we prepare ourselves in knowing where the trigger points are, okay, where that point where we're going to get the mass participation comes in. But then more importantly, we just utilize the access to get us involved within that structure. Okay, so key tail reversal support. This is the initiative, or this is the key auction reversal. Okay, so we can see that we have one time framing coming into it, relatively high volume. We have one time framing coming out of it. Okay, nice symmetry in and out, right? Followed, and most importantly, like we said, we want relatively high volume, right? So we can see really good rejection. The moment we have that, we call that a key auction reversal. So what we're looking for is at some point in the future, this is obviously the S&P, the oil, at some point in the future, if we were to ever get back to this 3406 and we got access occurring before it, we'd be looking for a breakout to the downside. Okay, so all of the strategies, all of these structures, we are looking for breakouts of them, right? We're looking for them to resolve themselves and for the market to break out at some point. Okay, and that's pretty much all of them from the oil market. So that's the oil. Now, what I'm going to do, I'm going to go through the next chart with you. I'll show you the little variances, but then we're going to talk a bit more about the breakout. In other words, I want to kind of show you, look what happens here, look what happens here, look what happens here, right? And then you can go through the last couple of examples on your own. I want you to look at it with the annotations that I provided you with, and just make sure you understand the different 6 variations of structure. Okay, so the next market is GC. Now, the first is the key auction reversal. Again, that's the V. Notice the volume and notice the in and out. Notice the symmetry. Now, yes, like I said to you, it's not always going to be picture perfect, but we can see 1, 2, 3, 4, one time framing, 1, 2, 3, 4, 5, one time framing. Okay, so we have a very important key auction reversal level. Notice what happens when we get below there, which is this day over here. Okay, we can see quite a high volume, high volatility day. It takes out the level, also extends quite nicely below. Now, in terms of extension, we're talking about a $15 move to the downside on this day. Okay, the next one is a structural trend line. So we can see 1, 2, 3. Now, in this instance, we would actually call this an initiative structural trend line. This is not a range trend line. This is actually an initiative trend line. Why? Because we can see the market initiating once off of it, twice initiating, and 3 times. In other words, there are sellers that are very aggressively navigating price away from that price point. Once we have the 3, which is at this point only, we put the trend line on and we call it a trend line or an initiative trend line. Okay. The most important thing is that there's no difference between the breakout opportunity with an initiative trend line or a range trend line. They're one and the same, right? The point is we follow a rules-based approach for calling something a trend line. Now, alleged bottom, we can see market forms a low. A couple of days later, comes and forms a low. This is the opportunity, right? This is that stop run. This is that the market wanting to very quickly maneuver through that. Now, as a rule of thumb, and again, I didn't want to give away too many hints, but with ledgers, right, those are the stop liquidations, okay? And remember what we said about stop liquidations. We need to be more aggressive on them and we need to be willing to preempt on them. And we'll see what this looks like when we actually get to the access charts in a bit. Now, the next one is key monthly low support. So again, we can see double bottom on this month, made another bottom on that month, and eventually on this day, we broke out of that 4-month range. Okay, so price discovery mode. Again, we've got another key auction reversal. As you can see, the one time framing, 1, 2, 3, 4, 5, 6, and followed by a very quick, swift unraveling of the price action. Okay, so nice key auction reversal. If we ever get back to that price point of 1972, we will have a very nice tradable opportunity. Okay, and then we've got here a nice consolidation structure. Okay, so we can see the market's bending 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and on the 11th day it breaks to the downside. So we call this a nice consolidation structure, and we're looking for a breakout trade to the downside. Now, hopefully, a lot of you are saying, oh wow, that's interesting because we have a consolidation structure plus we have a key monthly low. In other words, Confluence. And remember what we said about Confluence. Okay, Confluence just means there's a greater number of participants with more reasons to partake. So the more structural breakout opportunities that line up together, the better, because there's a lot more people that are going to want to trade them. Right, so this is what we would call an A-star setup. In other words, when you do get confluence among structures like this, okay, those are the ones you'll tend to see me tweet about because those are the ones I'm highly convicted about that are going to break out because there's going to be such a mass participation on them. Okay, and then the last one is the ledge low here again, where we have a nice little 1, a nice little 2, a nice little 3, and on this day, we break the ledge to the downside. Okay, now notice with ledges, and this is important to differentiate, ledges don't necessarily mean breakout and continuation. Okay, and again, note what I've said there because these are the observations you've got to put into your notes. Right? Ledges don't necessarily imply continuation. Price discovery breakouts do tend to imply continuation. Right? So this is why you've got to learn to first and foremost differentiate between the structures, but then also differentiate between the type of breakout because some breakouts are going to break and continue, i.e. like this one here, which is a consolidation breakout combined with a key monthly low, versus the ledgers, they tend to just snap, and some of them do continue, but more often than not, all we're looking for on these types of structural breakouts is the fast money move, the liquidation moves. Now there's the hint for you. If it's a fast money move and a liquidation move, those are the ones that we want to be preempting. Okay, so hopefully I'm not giving too much of the answers away, but that's then our first two markets. Now what I want you to do, and we're going to take a little bit of a pause after this, I want you to go now through the GC, which is the third of the markets, sorry, we've just been through GC. I want you to go through the BTC, I want you to go through the 6E, and I want you to go through the E-mini S&P. Go through these 3 daily charts. Go through the structures. Go and observe the structures. Look what they do the day after. Familiarize yourself with them so that you can really start to see the different kind of structures. Also note which ones you like. Okay, some structures you'll have a natural tendency to like more because you'll understand them better. Right? So start to think like a trader. Start to think, which one of these would I adopt? Do I want to adopt 2 of them maybe? Right? You don't have to adopt all of them. That's important to stress. But the important thing is to start to get an idea of what these structures look like and what the potential opportunity is through recognizing the pattern time and time and time again. Okay, so I want you to take a pause now. Push pause on this. It's important you go and do this exercise first. I'm not going to pause the recording. I'm going to keep going. But pause, go and do those 3 observations. And we're going to finish the part 1 off now by going through the trade idea and then taking you through the textbook example, taking you through the nuance example, as well as taking you through the variations, okay, the nuance. So this is the basic trade idea. It's market flows, okay? That's all structural breakouts are. It's market flow. Now, we're looking for volume and volatility triggered at specific reference points within specified structures. Note the wording, specified, okay? Reference points, i.e. triggers, volume and volatility, and market flows, right? If I was to summarize the entire summary of this trade opportunity, there it is right there. Market flow, volume, volatility, triggers, and specified structures, okay? Awareness of the structure and potential for large time frame participants to create opportunity. In other words, we're aware of it. We know that at some point those structures are going to break. Maybe today, maybe next week, maybe in 6 years' time. Who knows? Right? The reality is we have to be aware of them. That's our job as traders, is the awareness. Because when we get to that point, the large time frame participants are coming in. Okay? Now, it's important that I note that awareness, I said it can happen a couple of years. And the good example is Bitcoin. Okay? Bitcoin made a high back in 2017, and it only took out that high 3 years later. So it only went into price discovery mode 3 years later. So it's important just to recognize that you've got to always be aware of your market. And I mean every aspect of your market, because our job is about opportunity. Our job is about being opportunistic and taking advantage when that time comes. Now, timing is key, and that's crucial. Access is the opportunity. That's the one that's telling us, hey, Bran, that structure, you remember that one you called price discovery in Bitcoin at 20,000? You remember that one? Well, now I'm giving you access to it. And what's really cool is I'm going to show you the access to the Bitcoin breakout. I'm going to show you what it looked like later on. Now, note it's predetermined. Okay, we've got to take predetermined rules-based structures. Not just any old structure, not just draw a line and call it support. No, it's got to be predetermined, rules-based. In other words, we have those lines in place before the market opens so that when we're watching the markets and when the market says, hey, there's access, then we take advantage of the predetermined rules-based structures. Okay, now filters. You're going to need one filter for all 6 structures. Okay, you have to have one filter for all 6 structures. And this filter is nothing other than being able to define your type of structure. Okay, so I've just used the price discovery high-low. And this is pretty straightforward because you can just take the rules that I've used within the previous slides. However, remember what I said to you. These are my rules. Okay, you've got to understand your own rules because you might find better rules than what I apply. And as a result, you may get better execution opportunities. Now, for price discovery mode, remember we said it's either record prices, which is very straightforward. It's either uncharted area, in other words, months or years, we break into a new zone, or it's a new fundamental driver in the market. Now, that's the trade idea, and that's all I'm going to do for most of this lesson until we get to the prescribed rules. Then I will take you through my other parts of my template. Right? The objective is for you to now go and fill out the template yourself with the understanding that I've already provided you with, as well as some of the hints. So, to give you some more hints, we're going to go through the first 3 examples. Okay, and we're going to start off with the 6 E. Now that's the daily chart. What I have done in this lesson is I've included the daily structure. So we'll talk about the structure first, just to bring you up to speed with which structure we're trying to break out of. And then we're going to look, as per normal, on the 15-minute charts for the breakout opportunity, for that access that's being provided. Now, okay, the example is from the 5th of November. So the 5th of November is over here. I just need to look it on the chart, okay? And what we're looking for here is the breakout, the continuation of the key auction reversal. In other words, we've had a key auction reversal here, okay? And the market is now looking for a continuation. But what I want to show you is that we actually had an example of a key auction reversal on the 15-minute time frame. In other words, this is the chart from the previous day, okay? This is now the 15-minute chart of the example we're looking at. This day here was a key auction reversal, okay? In other words, we're looking for the breakout of this key auction reversal, okay? And that is where the opportunity comes, and that's where we're paying attention to. In other words, we recognize the structure, we recognize the potential for a breakout of a key auction reversal, and all we're doing is watching for that access to come in, okay? Notice the market gives us nice consolidation access. Once we break out of that consolidation, notice the confirmation, okay, with both relatively high volume and delta, and the market has a nice little continuation pattern. Okay, so that's what we're looking for here. That's what we're trying to identify is we see the structure, we recognize the structure, and then we recognize the potential opportunity within that structure. Now, like I said to you, these structures, and this is why I wanted to include this example, we're using the daily chart here. Okay, so on the daily chart, we can identify various structures. We can do the exact same thing on a 120-minute chart. We can do the exact same thing on a 15-minute chart. Personally, I wouldn't advise going less than 120 minutes because the type of opportunities you'll get on the 120 and the daily will be sufficient. There's more than enough opportunities, but equally, they tend to provide cleaner, easier opportunities with better risk-reward profiles. However, sometimes, as you can see in this example, we do get the exact same key reversal auction playing out on a 15-minute time frame, and it doesn't matter. The process is exactly the same. We identify the access, we know where the key level is, and we look for access just before the breakout. It gives it to us, and we get on with the market. Now, I'm not going to talk too much about where we stop out. I think you know where that is by now. What I will say, remember, as a rule of thumb with breakouts, most of the structures we're going to talk about, barring obviously the positioning liquidation or the ledgers, most breakouts tend to be a form of continuation. Okay, so they've got really good reward parameters, which means we want to be sure that we don't just stop out unnecessarily. So personally, what that means is I'd rather take a little bit more risk to be wrong rather than be too tight and put, for example, my stop on the actual low of the access candle, as we spoke about in the access methodology. Again, there's different ways to do this. I'm not going to give too many hints. We'll talk about this a little bit later when we get to the prescribed drills as to how I approach stop management with breakout trades. Okay, so the second example is again on the 6E. And this time we're looking at the 29th of October. So I'm just going to show you what that looks like on the chart. Okay, so the 29th of October is this day here. So we're looking for the break of this ledge. Okay, and remember we said ledges don't tend to have continuation. They tend to be more fast money trade opportunities. So we're looking for the break of this ledge at 117.33. Remember, these lines are nothing other than our trigger points. They are our reference points where we believe the flow and the volatility will come, and we're looking for access either before them or over them so we can partake in the breakout. Now the example, okay, it's a bit of a nuanced example in a sense. Yeah, we can see where the 117.38 is where the ledge comes in. And we can see once the market breaks below the previous day's low. Okay, so we can see early on in the session, there's some very good access taking place. Okay, so the market has very high volatility as well as delta. So it's a simple high delta, high volatility access candle. All right, now, and this is important. Where you play the breakout of any one of these 6 structures depends on you ultimately. Okay, it depends on the approach you're taking. It depends on how you want to manage the trade. Sometimes the market is going to give you very early entry opportunity, very early access. Okay, you will know the structures there, you will know the ledge exists, and you will get this almost gobsmackingly amazing opportunity to go with the mass participation. Sometimes you're not going to get any access. You're not going to get any warning and you're going to have to forego trades. The point is that there's always going to be a degree of nuance. But the process you follow will never be nuanced. You've always got to follow the same process. And that's what you have to spend the time learning and defining. Now in this example, yes, we could argue we could have got in on that access candle. Okay, I didn't. It's not the way I play ledgers. So it's got to be personal as to how you access it. However, the market began a process of one-time framing. So we started to see the market steadily roll over. Now, the moment the market shows early access and then we start to get a process of one-time framing, it's showing us a bit of weight in the market. Okay? And all of a sudden, the market came down and eventually took out the ledge. And you can see it took it out by only a couple of prices. Okay? Eventually, the market had another access candle and decided to have a continuation pattern. Okay, so where's the opportunity at? Well, if you do take this trade and you do like ledges and you take it early, well, you got a very good early signaling to take the trade opportunity. Equally, you can see the market didn't even put you anywhere off sides. No pressure, nothing like that. Had you got in early, okay, we're talking about a decent sort of, 50 pip move, okay? So the important thing is to differentiate between how you want, or first and foremost, which structures you like, and then learn how you're going to play those structures based on the observations of seeing them time and time again. Okay, and then the third example is from the E-mini S&P, and this is a bit more of a nuance failure, okay? And this comes from the 8th of October, and what we can see is the 8th of October is this day. Yeah, so again, what we're looking for is a bit of a ledge. So we can see 1 day, 2 day, 3 day, and 4 day. So we're seeing a 4 day or even a 5 day ledge structure. Okay. Now for me, the trigger point is this daily high. Why? Because it's so relatively close to the other 4 days. So we've got this ledge structure formed in the market, and now we're looking for a breakout opportunity on this day. Okay. And what we can see is just ahead of that ledge structure, we can see the market comes into it one more time, tests it, and then we get this little consolidation pattern forming. Okay, so we can see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 candles. Eventually we get that break. Now notice the pickup in volume and the pickup in delta. Now what I would say is look at the time of day is 2:45 a.m. Market pretty much sits sideways, moves, comes back and tests that structure before continuing. Now it's important again, when you go through your observations, when you go through your template, note this thing called time. Okay, why? Remember what we said about any kind of access. Ideally we want it in cash hours. Why? Because that's where mass participation is easier to identify, but also it's more likely to continue. So as a general rule of thumb, I will very rarely trade a breakout structure outside of cash. Okay, as a general rule of thumb. Now that's not to say you have to apply it. You have to apply a methodology that you can be consistent with. Okay, the other reason I don't tend to trade them outside of cash hours is because I'm a trader that believes in sleeping and managing my time and working within a certain specified time of day. I create my own rules to trade the market. Now it's not to say that's the best way to do it. Remember that 7-figure trader I was telling you about? The one that stays up till 3-4 a.m. in the morning? Okay, different ways to skin a cat. The important thing is you have to define what works for you. Okay, so those are the 3 examples, and what I want you to do now is go and fill this out. Go and fill out the trade strategy. I think I've given you enough hints. When we come back, I will spend a little bit of time talking about expectations, characteristics, and statistics for the discovery mode. In other words, when the market tends to go into new price discovery. Okay, I'm going to deal exclusively with price discovery template throughout the rest of this lesson, but you need to create a template for each one of the structures that you plan to adopt. Once you've done the trade strategy specifics, Okay, start having a look at the access methodology. What type of access is it giving you? And then lastly, go and put your notes in. Put the variations, put any kind of statistics that are important and relevant to that trade strategy. Okay, that's the end then of part 1. When we come back, we'll continue with more examples.